With Palantir's Q1 earnings just around the corner, it's always good to line up all the facts and predict the outcomes. One of the most common tools is the Zacks consensus, which averages the predictions of all analysts. And what we need to know about analyst predictions is that it doesn't matter. They're kind of like the weather forecast, they're always off. And even if they somewhat get it right once in a blue moon, the stock price may not behave appropriately. Let's take a look at a couple examples. Okay, so here's my first example, Twilio. As we can see here, we have the consensus EPS represented by this blue hole right here. So if we zoom in a little bit, over the last 4 quarters, the consensus is always down here, whereas the actual is up here. So they always underestimated the actual earnings. But take a look at how wide the margin is. Negative 9 cents compared to actual positive 9 cents. So instead of losing $1 billion, they're making $1 billion. What good are these analysts? And it just carries through every single quarter. Negative 3 cents to positive 4 cents. Negative 7 cents to positive 4 cents. And this one is a little bit wider, negative 9 cents to 5 cents. Just looking at this Q1 21 beat by 14 cents, negative 9 cents to positive 5 cents, what do you think happened to the stock? This stock reported just a couple days ago, and I'll show you. By the looks of it, the stock would probably hike up like 5-10%, right? Well, not exactly. Let's take a look. They reported May 5th after markets. It ended the day at 335. And automatically over the next day, it dropped below 300. So 335 to under 300, that's just about over 10%, maybe 11-12%, even though they beat the consensus by a wide margin. And this consensus is an average for like 27 analysts. 27 analysts that does this full-time day in and day out. And every single quarter, they get it wrong. So what good are they? The second example here is Fastly. They also reported over the last week. And what we see here is a little bit different. This one's like a traffic light. Green, red, green, red. So they've been kind of correct half the time. But if we look at the most recent Q1 earnings, they missed by only 1 cent. The estimate was losing 11 cents and they actually lost 12 cents. So what? Then now we scroll back up to the stock charts. Over the past couple of days, this was an elevator drop. It ended the day at 58. And over the next day, it dropped to 44. 58 to 44, that's like 25% plus over the course of one day. And they barely missed the consensus EPS. So why does it matter? So after seeing these two examples of Twilio and Fastly, if the consensus EPS doesn't even matter, then what should we look at? I've always been more of a visual learner, and I like to convey my messages through like an analogy or a sketch. So in this case, I'll use a sketch. Okay, so this is a really simple sketch of a 2x2 matrix. It sounds complicated, but it's just a box with 4 squares. A box with 4 squares. Close enough. And then we just draw 2 lines across like that. We'll put relevant information into each of these 4 bins. Okay, now let's label the 4 bins. So on the left side here, we have the positives. Right side is the negatives. Right here, the upper 2 squares represents internal. And bottom 2 squares is external. So what does this all mean? The internal here means what's within the company. The external is everything outside the company, kind of like the market sentiments, the interest rates, what the competitors are doing. It's just everything outside the company. Positive represents positive catalysts, which may drive the stock up. Negative is the news that may drive the stock down. Now we'll try our best to fill the squares for Palantir and evaluate the potential for each piece of information. Let's start off with the easiest, the internal positives. So what has happened for Palantir over the first quarter, which is January to end of March of 2021? The most obvious one is the government contracts with the COVID. And this has been ongoing for the past year. They pretty much dominate this space because they integrated the systems really early on in the US and UK database, and the effects are a whole lot better than the countries without the Palantir software. So that's kind of a confirmation that this software is working. And from now on, any country that kind of wants this AI machine learning to help with this contact tracing may have to resort to Palantir. They've kind of solidified their position as a default solution in this industry. Another one are corporate clients. As we looked at in the previous video, if we pull up the spreadsheet again, these 8 companies, Sample Holdings, Fujitsu, Rio Tinto PGE, Farsia, Amazon AWS, IBM, and 3M are all contracts signed in the first quarter of 2021. There could have been other contracts in the background that we don't know of. They could have signed an NDA, which is a non-disclosure agreement. And it's very reasonable because let's say if I was a company hiring Palantir and things are working where it's generating me more profits and saving me costs, I wouldn't want to release that info to my competitors. If all the competitors have this same software, then the playing field is even. And we don't want that. We want the upper hand in this for as long as possible. I'm still not really sure why Amazon AWS would release this information. Like, how would all this possibly benefit them? If during the pilot phase, they see that Palantir software is working, and as I said, is increasing their top line and bottom line, wouldn't they just keep it to themselves and possibly just buy them out? Or maybe sign an exclusive partnership where they can't partner with any other cloud companies, like the Microsoft Azures or the Google Clouds. Since AWS has that huge lead already, why won't they just keep extending that gap instead of releasing this information? I'm still not really sure, but we're gonna move on. Another positive is that we keep seeing the renewals of all the contracts that was signed a couple years ago, mainly government contracts, but they're all renewing multi-years. Even the corporates like BP, they renew for a 5-year contract. All this kind of gives a confidence boost that the software is working and it's just not a one-time thing. For BP's example, they started working with Palantir in 2014 and they renewed the contract just this year. So for the past 7 years, they've been working with them. Things are going great. And just earlier this year, they signed another 5-year extension. These are all positive news that happened over the first quarter. All public. We don't know what goes on in the background. There may be another 50 contracts in the back that we don't know of. But we might find out more in the company earnings on Tuesday. Now we'll look at the internal negatives. And there is a handful. Before we get to that, if you like this presentation whatsoever, drop me a like and subscribe because it really helps out the channel. Thank you. The most glaring one is that Alex Karp, the CEO, came out and said that the Palantir software is free for everyone. So all the onboarding costs will be eaten up by Palantir themselves. What that means is that the top line will be zero for every onboarding customer. And it'll take time to go through all the pilot phase in order for them to get a real contract. Like what we showed before, this pilot program will cost a lot of money to bring in new customers. And we can only expect real contracts during the expand and scale phase. So everything up here, we get nothing. But it'll cost them money as well. If we go back to the equation of profit equals revenue minus expense, what they're essentially doing by onboarding every client for free is that they're driving down the revenue because there is no contracts being signed and everything's free, but the onboarding expense has gone up. Both these factors together are going to drive the profits down. And there weren't much to begin with anyways. So we'll definitely be in the cash burn phase for a little while. So the short-term earnings will take a hit from this strategy. But, and that's a huge but, this is essential to win in the long game because the Palantir platform is built on data. And if all these companies are opening the books to them, opening all their silos and gates to Palantir, then Palantir is getting unlimited data through all the different industries. And they'll win in the long game. In the short game, it's a huge cash burn for sure. Okay, so the first one is free platform. The second one can be a huge concern as well. It's all the insiders, which means like all the upper management are selling shares just before the earnings. As we can see here in the SEC website, for Palantir Technology, over a span of 3 days, we have 4 different transactions from 4 different upper management. The first one is Peter Thiel, second one is Alex Karp, third one is Stephen Cohen, fourth one is Alex Moore. All of them are either directors, founders, or someone in the management team. If we just go on this website, Wallmine, and just type in Palantir, we find this information that over the past 4 days, these 4 guys have sold these shares. And it's not a small amount. Right here it shows that Alex Karp has sold $40 million. The other 3 guys combined for another million. So $41 million, just a couple days before the Q1 earnings. What the heck is that about? From an ordinary eye, it may be like they know something from the inside that says, oh, this report is gonna suck. Our earnings are deep in the red, and we need to get our shares out. We need to get out our money. Well, that may not be the case, because if we just type in insider trading fraud, it says that securities fraud and insider trading is illegally trading stock in the open market using confidential information. And selling just before the earnings because you know the report isn't so great, it's pretty much saying here, Arrest me now. These guys are billionaires. They're not idiots. Why would they possibly trigger their sales right before the earnings when that's the most obvious move they can make? And it's just $41 million. If we go back to the website here and we scroll down, they've sold many shares throughout the past year. And sometimes it's upwards of 200 million. And I think there's another transaction right here. It's for $500 million. Just these 4 transactions doesn't really mean much. So that's the second point. Management is selling. Here's an article that happened just 4 days ago that may justify why the upper management is selling all these shares. Palantir hires former IBM Watson Health exec as its first US government chief medical officer. So that happened just 4 days ago. It kind of goes with the timeline when the upper management sold all these shares, or sold or transferred. In any larger businesses, if you want to sign the best personnel, it's not just about salaries, it's about stock options and shares of the company. So is it possible that these management have sold these shares or transferred them to the CMO? The timeline kind of makes sense, but that's just a wild guess. That's something I would do to hold on to the best personnel out there. And now to the external negatives. One of the most recent news is that Janet Yellen came out and said they may consider raising interest rates. So up interest rates. When and if they raise interest rates, that means there is less money to flow around. When there's less money to flow around, people tend to gamble less on these high flyer companies, high flyer speculative companies, which aren't profitable as of yet, and they're a huge cash burn. So for the whale investors, they will have less money to work with, and they have to be a little bit more choosy on where they dump the money. If this money supply shrinks, so does all the investments. Therefore, that's an external negative driver, especially for these growth tech stocks. And we've seen all of them take a hit over the last couple weeks. The second one is that people are shorting ARK Invest since February. Shorting ARK. Here's the article that says the number of shares shorted in Cathie Wood's ARK Innovation ETF has jumped 195% in the last 30 days. This article is from March 9th of this year, and 30 days before that would be February 9th. So as we can see here, approximately February 9th until now, ARK Invest Innovations ETF has gone down from about 155 all the way to 109. That's a good 40% down on the whole ETF. If we look at the top holdings for this ETF, Tesla, Square, Teladoc, Roku, Zillow, Zoom, Spotify, Shopify, Baidu, Twilio. And then if we go down to see all the holdings of ARK ETF, we see that Palantir is number 19 on the list. So pretty much all these guys have been shorted for the past 4 months. And many of them has gone down 30, 40, 50%. And this external factor will always be in place. There will always be hedge funds who wants to short the high flyer ETFs. So what needs to happen for us to get out of the rut is actually deliver solid numbers. If these companies start to deliver solid numbers, the smart money will come back in and will cause another short squeeze. That's kind of what happened back in January when things popped from 35 to 45. Right now we're at a calmer level at $20. But what we have is time to see how everything plays out. And hopefully the earnings will start reflecting the core business and how our vision will play out. So in the last box here, I can't really think of anything other than their partners' blowout earnings. So I'm just going to write down partner blowout earnings. As we saw in this spreadsheet, these 8 companies that just signed with Palantir this year, 6 of the 8 partnerships stock price has gone up. 4 of them are up double digits just from the date they signed the contract. So that's definitely an external positive factor. What do you think will happen for the earnings on Tuesday? Let me know in the comment section down below. There isn't much expectations for me because it's so short term, but in the long term, I'm cautiously optimistic. Hit the like and subscribe if you found any value in the video. As always, thanks for watching, take care, and I'll see you in the next one.